In the wake of the 2008 financial meltdown, Congress passed a new set of regulations, the 2010 Dodd-Frank Wall Street Reform and Consumer Protection Act, also known as Dodd-Frank. The legislation looked to reduce systematic risk through a wide range of policies, including new limits on derivatives trading, stricter oversight of banks, and greater consumer protections. A major point is the so-called Volcker Rule, named after the former Fed chair, which prohibits federally backed banks from proprietary trading or making risky bets with their depositors' funds. Dodd-Frank introduced what is essentially a third official mandate for the Fed, alongside its inflation and employment targets, by expanding its oversight of the financial system. It does that in part via the Fed's participation in the newly created Financial Stability Oversight Council, which identifies risks to the system and imposes new regulations as needed. The Fed is also now in charge of keeping a closer eye on banks' solvency to ensure that they have enough reserves to survive another major downturn. All financial firms big enough to pose a risk to the broader economy, known as systematically important financial institutions, are evaluated yearly with so-called stress tests that stimulate the conditions of the economic crisis. These policies together represent a consolidation of oversight in Washington. Previously, the regional reserve banks and the New York Fed in particular took the lead on regulating banks in their territory. If you have any other questions, let me know.